What does it mean to save versus invest? Let's start with the basics. We hear people say you should be saving more or you need to invest early, but what do these really mean? Saving simply means setting aside a portion of your money and keeping it safe. Usually, this money goes into a savings account, a money market account, or even a jar on your shelf. The goal of saving is safety and liquidity. You want that money to be accessible when you need it with minimal risk. On the other hand, investing means using your money to buy assets that you believe will grow in value over time, like stocks, bonds, real estate, or mutual funds. With investing, there's always some level of risk, but also the potential for higher returns than saving. So in simple terms, saving is protecting your money. Investing is growing your money. Both are important, but they serve very different purposes in your financial life. Now, let's talk about mindset. Most people feel more comfortable saving than investing. Why? Because saving feels safe. There's no risk of losing your money in a bank account. You know it's there, it's stable, and it gives you peace of mind. But the downside? That money barely grows. In fact, if your savings account earns 1% interest and inflation rises by 3%, your money is actually losing value over time. Now let's flip to investing. The idea of putting money in the stock market, where prices go up and down, can feel intimidating or risky, especially if you've never done it before. But here's the irony. Not investing can be even riskier, because your money won't grow enough to beat inflation, reach your goals, or build wealth in the long run. So why do people avoid it? Lack of knowledge, fear of losing money, bad experiences or horror stories, thinking they need a lot of money to start. But the truth is, you can start small. You can keep it simple. And with time, investing can work with you to build real financial power. Let's take a deeper look at saving. Pros of saving. Low risk. Your principal stays safe, especially in insured bank accounts. High liquidity. You can access your money quickly, often without penalties. Great for emergencies. When your car breaks down or medical bills pop up, savings are your safety net. Useful for short-term goals, like a vacation, down payment, or buying a new phone. Cons of saving. Low returns. Most savings accounts offer 0.5% to 1.5% annual interest. Loses to inflation. If inflation is 3% and your savings earn 1%, your buying power is shrinking. Too much saving can slow wealth growth. If all your money is in savings, you're missing growth opportunities. Here's an example. You save $10,000 in a savings account at 1.5% interest. In a year, you earn $150. Not bad, but not game-changing either. Now imagine inflation was 3%. You technically lost $150 in value. That's why savings are great for security, not growth. Now let's shift to investing. Pros of investing. Higher returns. Historically, the stock market has returned 7 to 10% per year. Compounding growth. Your gains earn gains, which builds wealth faster over time. Beats inflation. Unlike savings, investments often outpace inflation in the long term. Wealth building. Investing is the primary engine behind most long-term financial success. Cons of investing. Risk of loss. The value of your investment can go down, especially in the short term. Not liquid for emergencies. Some assets are harder to cash out quickly. Requires research or guidance. Picking random stocks isn't a strategy. Quick comparison. Let's say you invest $10,000 in a simple index fund that returns 8% annually. In 10 years, it grows to nearly $21,600 thanks to compounding. Compare that to saving the same $10,000 at 1.5%. You'd only have $11,600 in 10 years. That's a $10,000 difference just from how you chose to use your money. So let's compare saving and investing side by side, not in a boring table, but in a way that actually makes sense to you. First, think about the purpose. Saving is all about safety. You're preserving your money, keeping it accessible, and using it for short-term needs. Investing, on the other hand, is about building wealth. You're putting money to work in places that could grow over time, like stocks, bonds, or funds. Second, let's talk about risk. With saving, Your money is generally safe, especially in insured bank accounts. There's almost zero risk of losing your original amount. But with investing, there's always some risk. The value can go up or down. That's the trade-off for potentially higher rewards. Third, the returns. Savings accounts usually earn you around 0.5% to maybe 2% a year. Not much. Investments like index funds or ETFs can earn anywhere between 7 to 10% a year on average, though this depends on market performance and time. Fourth, liquidity, or how quickly you can access your money. Saved money is highly liquid. You can pull it out anytime for emergencies or expenses. Investments vary. Some, like stocks, are pretty liquid. Others, like real estate or retirement accounts, might take longer to access or come with penalties. Fifth, the time horizon. Saving is best for short-term goals, things like a new laptop, a vacation, or your emergency fund. Investing is ideal for the long game, retirement, building wealth, or buying a home 5 or 10 years down the line. And finally, inflation. Here's the harsh truth. Most savings accounts don't keep up with inflation, but good investments typically do. Over time, they help you grow not just the amount, but also the value of your money. So to recap, saving keeps your money safe. Investing helps it grow. Both are essential, but they serve very different roles in your financial life. Now that we've unpacked the differences, let's talk timing. When is saving the right move? The answer lies in your goals and your stage in life. If you're just starting out, don't worry about investing just yet. Your first priority should be building a cash cushion, an emergency fund. An emergency fund is your backup plan. It covers you when unexpected things happen. Your car breaks down, you lose your job, or there's a medical expense you didn't plan for. Most experts recommend saving at least 3 to 6 months worth of living expenses in a highly liquid, low-risk account. This gives you a safety net that keeps you from relying on credit cards or personal loans in tough times. You should also focus on saving if you're planning for short-term goals. That could be a vacation, a laptop, a wedding, or even a down payment you'll need in the next couple of years. If you know you'll need the money soon, keep it saved, not invested, because the stock market can fluctuate in the short run, and you don't want to risk losing money when you need it most. So if your timeline is short and the goal is clear, saving wins. When is it better to invest? Now let's look at the other side. When does it make more sense to invest? If your goals are long-term, like retirement, buying a home 5 years from now, or simply building wealth over time, investing is your best friend. Why? Because time is the most powerful tool you have as an investor. The longer your money stays invested, the more opportunity it has to grow. Thanks to the magic of compound growth, your returns can snowball. Let's say you invest $1,000 and earn an average of 8% annually. In 1 year, that's $80. But in year 2, you're not just earning on your original $1,000, you're also earning on the $80 from last year. Over time, this compounds into real wealth. This is why investing early matters. The earlier you start, even with small amounts, the more time your money has to multiply. Another time to invest is when you've already built that emergency fund and covered your short-term needs. Once you're stable and secure, your extra cash should be working for you, not sitting idle. Investing is also ideal if you have a steady income, low debt, and are ready to take on a little more risk for a greater reward. So, if you have time, stability, and long-term goals, investing should absolutely be part of your plan. If all of this is new to you, don't worry. Let's talk about how to get started, step by step. First, start with saving. Open a basic high-yield savings account, ideally one that earns more interest than a standard checking account. Begin by automating a small transfer every month, even if it's just $50 or $100. Build your emergency fund. Get to that 3 to 6 month target. This step gives you breathing room and confidence to move forward. Once that's done, you're ready to explore investing. But don't dive into complicated strategies. Keep it simple. Start with index funds or ETFs. These are collections of stocks that track the market as a whole. They're low cost, diversified, and historically deliver solid returns over time. If your job offers a retirement account like a 401k or similar, and they offer a match, take it. That's free money. If not, you can look into opening a brokerage account or retirement account, depending on your country. Many platforms now let you start with as little as a few dollars. And remember, you don't need to be an expert to start investing. But you do need to be consistent, patient, and long-term focused. As you begin your journey into saving and investing, you'll want to steer clear of a few common traps. The first mistake? Trying to skip saving and jump straight to investing. This can backfire if you suddenly need cash and have to sell investments during a market dip. Always build your foundation first. Second, waiting too long to start. People often delay investing because they think they need a lot of money. But time in the market beats timing the market. Starting small today is better than starting big someday. Third, going all in on one strategy. Putting all your money in savings is safe but slow. Putting everything into high-risk investments is bold but dangerous. The key is balance. Fourth, reacting emotionally. When markets drop, don't panic sell. When they rise, don't get greedy. Stick to your plan. Investing rewards the calm and disciplined. And finally, ignoring fees and taxes. If you're investing in mutual funds or using financial apps, make sure you understand the costs. High fees can quietly eat away at your returns. Likewise, understand how taxes might apply to your investment gains. Avoiding these mistakes won't make you rich overnight, but it will set you up for long-term success. So, how do you put all of this together? Here's a simple way to think about it. Start with saving for security. Build that emergency fund and meet your short-term needs. Then move toward investing for growth. Focus on long-term goals and let your money start working for you. A good rule of thumb many people follow is the 50-30-20 rule. 50% of your income goes to needs, 30% to wants, and 20% to savings and investing. Within that 20%, you can split between saving and investing based on your personal situation. If you're just starting, maybe it's 15% to savings and 5% to investing. As you grow more stable, flip it. 5% to savings and 15% to investing. And always review and adjust. Life changes, your strategy should too. The most important thing is to be intentional. Don't just spend what's left after you've lived your life. Flip that. Save and invest first, then spend what's left. Because ultimately, it's not just about money. It's about control, freedom, and building a future that gives you more choices, not fewer. Saving and investing aren't either or. They're both tools. Use them wisely, and they'll take you far. If you found this video helpful, consider hitting subscribe. I make more content that helps you take control of your financial life, one smart decision at a time. Until next time, stay aware, stay prepared, and let your money work as hard as you do.